Hey, Dr. Two. Here is my final presentation for Seminar in Finance. First thing I'll talk about is Starbucks competitors. Their direct competitors include Costa Coffee, McDonald's Cafe, Dunkin' Donuts, and Cafe Coffee Day, and also local restaurants. Most of these competitors, they serve the same foods, the same products, so very similar pricing. And then indirect competitors would be, people choosing to make their coffee or breakfast at home rather than buying it on the go. The barriers to entry are very minimal, and just because, or very, very competitive market, but the main barriers is lack of startup capital. It takes quite a bit of money to purchase land and to build just the building itself. And if you don't have enough sales in the beginning of the company, you could go belly up pretty quick. Consumer skepticism relates to consumers not really knowing a company and not wanting to buy stuff from there just because they're a little afraid it might not be too good. And then location's a big deal. Most Starbucks have a really good location, and it's where you can get in and out real quick, and it's in a very busy intersection. And then marketing. You got to spend a lot of money on the marketing to get your name out there. So those are kind of the main barriers to entry. Causes not too many restaurants to open up. When determining my beta, I used 3 years of stock prices for Starbucks and the S&P 500. I used the adjusted close price and calculated the percent return from day to day. Then I calculated the covariance and variance of Starbucks to the S&P 500. Then I divided covariance by variance to get my beta. My beta ended up being 0.8368, and this basically means that Starbucks price generally swings whichever way the S&P 500 swings. And but the good thing is it's not over greater than 1, so it doesn't swing more than the market. So the good thing is you can look at that as, the market's doing good and Starbucks has a good chance of doing well as well. So, and then the flip side, if it's doing bad, then Starbucks probably isn't doing very good either. And so the present value of future cash flows, you can see this in my Excel sheet. I'll include when I send this to you, but the assumptions that I made is a 2.5% increase in revenue. Cost of goods sold is 41% of revenue. 1.5% increase in operating expenses. Depreciation expenses are staying consistent at 1,305,900. Interest is staying consistent at 170,300. Tax rate staying consistent at 27.5%, and dividends will consist of half of net income. And so here in my spreadsheet is my projected income statement showing my revenue, cost of goods sold, operating expenses, depreciation expenses, taxes, earnings after taxes, depreciation expenses again, the change in the funds, and then I have my free cash flows, and then it shows that it continues to increase year from year. So that's a good sign. The present value of free cash flows, it shows it increasing as well, and then my present value of free cash flow per share. So we're saying that based on projections, it is doing good as long as all assumptions are met. And then here's some of my some other factors to consider. Book equity, it continues to increase from year to year. The plowback ratio staying consistent at 0.5. Return on equity, it's really high in 2018. That's probably due to not having all the real numbers, and it's probably coming to a more normalized number as years go on. The same as growth rate, it shows a lot of growth in 2018, but then it dwindles down to 20% in 2023. Based on my present value, expected earning per share is $7.19. Price per earnings ratio for this is 0.926, and then our PEG ratio is 0.014. So that's that's a key benefactor showing that the stock is highly undervalued. And my weighted average cost of capital, this is based on 2018 historical prices. My weight of debt is 38%. My weight of equity is 62%. The cost of debt is 4.21%. Cost of equity is 12%. Tax rate 25%. And it gives me 8.64% of my weighted average cost of capital. And this means that that's the minimum that return Starbucks needs to make just to pay back their stakeholders. That's what the stakeholders require. And so here's the other evaluation method that you included in Blackboard on November 25th. It's the earning per share, sales per share, total assets per share valuation. And, we compared these numbers to the actual price for 2016, 17, and 18. It shows that based on my spreadsheet numbers that these values are actually a little over what the actual value was, but in 2018 it got kind of more normalized. But this is just kind of good number just to kind of figure, what you, based on, viewer discretion of what you want to analyze, it kind of gives you a good number on what to base, a good price to purchase that. And then here's just the average as far as difference in the price. And so we see that earnings per share was actually the closest to it, but still was still higher than the actual price. And so based off this method, using 2019 projections, we're assuming net income grows to 4,416,214.34, and then earnings per share would be $4.42 with a million number of shares outstanding. These are big assumptions. And based on that, the expected stock price would be $67.61. Our current stock price is $66.55. And so the big conclusion is, do we purchase Starbucks or not? Why or why not? And yes, we do purchase it. Since the current price is less than the expected price for 2019, this right now would be the good time to invest. I would suggest wait closer to the end of the year to purchase, since the market has been dwindling down, and I believe it dropped 500 points, over the past week. So, it'd be a good time closer to the beginning of the year to invest in Starbucks. And one thing I'd say is, due to a high beta, I would suggest purchasing Starbucks when the market is down and when the market increases, and sell. But the good thing about Starbucks is, they have increased their net income and their profit in the past 3 years and should continue to do so. So I would definitely purchase Starbucks.